All right, let's deep dive, everyone. Today, we're going to take a look at two companies that are supposed to be huge winners over the next 20 years.
Oh, interesting. Which ones?
Dutch Bros and Toast.
Huh. Both in the restaurant industry. That's interesting.
I know, right? Pretty different, though, as we'll see.
So where'd you hear about these supposed winners?
This article from The Motley Fool.
Oh.
Are you familiar with them?
Yeah, they're a financial services company. Been around forever.
Right, since like 93.
Yeah, something like that.
Yeah.
They do financial advice, analysis, all that. They even have like premium investing solutions.
Yep. And their whole thing is making the world smarter, happier, and richer.
Well, hopefully richer at least.
That is the goal, right?
For sure.
Okay, so first up is Dutch Bros.
The coffee place.
Yep, ticker symbol BRO.
ROs. Got it.
And I gotta say, I love a good origin story, and this one's great.
Oh, yeah. Let's hear it.
So, two brothers, right?
Yeah.
They start a coffee business from a pushcart.
From a pushcart.
Yeah, back in 92. And now, fast forward to today, they're projected to rake in like $1.1 billion in revenue this year.
No kidding.
It's crazy, right?
That is impressive. And how many locations are they up to now?
By the end of the year, they're supposed to have 950 shops.
Wow.
Across 18 states.
And didn't they just have their IPO recently?
They did. So, yeah, definitely on people's radar.
For sure. A lot of people probably wondering if they should jump in on that.
Right. Like, should we be hopping on the BRS bandwagon?
Yeah. Is it a good investment or what?
Well, that's what we're here to find out. What do the numbers say?
Let's see. Well, they've had really consistent revenue growth, like over 30% year over year.
Seriously? That's huge.
It is. And even last quarter, they still managed 28%.
Wow.
Yeah.
Okay, so they're definitely growing. But is it all good news?
Well, here's where it gets a little more interesting.
Okay, I'm listening.
So 2/3 of that growth, it's coming from new shops opening,
Oh, okay.
not from like increased sales at their existing stores.
So they're growing by just adding more stores, not by like selling a ton more coffee at each one.
Exactly. Does that matter?
It might. Think about it, right? Rapid expansion can be risky.
In what way?
Well, each new location, it has to actually be profitable.
Right. Not just add to overhead.
Exactly. And in the restaurant industry, that's, not always easy.
True. Okay, so rapid expansion might not be all sunshine and roses, but their net income, at least, went way up, right, from Q3 last year to this year.
Oh, yeah, for sure. It went from like $13.4 million to $21.7 million.
That's a pretty big jump.
It is, like almost 62%.
Wow. So at least they're making money, right?
Exactly.
Yeah.
Profitable growth is what you want to see.
So good sign there. But, I mean, they're not just coffee anymore, are they?
Nope, not at all.
They're branching out, doing other drinks like lemonades, smoothies, even testing food some places.
Right, diversification, trying to appeal to a broader customer base.
Yeah, which makes sense, but is it a good move, you think?
Could be, but they need to be careful, right? Right, like how so?
Well, it has to make sense with their brand.
Yeah.
And they can't, spread themselves too thin.
Good point. Okay, so let's talk about stock performance. What are we looking at with BRS?
So the article mentioned their stock. It shot up 51% after their last earnings report.
Wow, seriously?
Yeah, it was a really positive report. And right now they have a price-to-sales ratio of 4.1.
Hold on. Price-to-sales ratio, what's that?
It's basically, think of it like this. It shows how much you're paying for every dollar of sales the company makes.
Okay.
So for Dutch Bros, you're paying $4.10 for every $1 of revenue they bring in.
Okay, got it. And is that good?
Well, for a growing company in the restaurant space, 4.1 is considered pretty reasonable.
Okay, so not like outrageously expensive.
No, not really. But not a screaming bargain either.
Right, somewhere in the middle.
Exactly.
Yeah.
But we always have to remember the risks, Even with a company that looks this good, at least on paper.
For sure.
Competition in the beverage market, it's fierce.
Yeah, tons of coffee places out there.
Right, and maintaining this super fast growth, it's not easy.
So there are definitely some things to watch out for.
Definitely.
Okay, so Dutch Bros, high growth, expanding quickly, and becoming profitable seems promising, but we got to keep an eye on those risks. Now, let's shift gears a bit, talk about Toast.
All right. Toast. Ticker symbol TOST, right?
Yep, that's the one. And this one's interesting because they're not, selling food or drinks directly.
They're different.
They're a SaaS company.
Software as a service.
Right. And they basically provide all the tech that helps restaurants run their business.
Oh, interesting.
Like point-of-sale systems, online ordering, managing deliveries, all of that.
So they're like the behind-the-scenes tech wizards, making sure everything runs smoothly in this whole digital age we're in.
Exactly. And get this, they're seeing incredible growth.
No kidding. Even with the economy being a little,
I know, right? It's tough out there. But yeah, their revenue is up 26% year over year. And the number of restaurants actually using their platform, up 28%.
So restaurants are really buying into what they're doing.
They are. But why? Is their tech really that good? Or are restaurants just desperate for any help they can get?
I think it's probably a bit of both, honestly.
Yeah, that makes sense.
The restaurant industry is, well, notoriously difficult. Owners are always looking for an edge.
For sure.
Ways to be more efficient, cut costs, improve the customer experience, especially with online ordering and delivery being so huge these days.
Right. So what are they doing specifically that's so, innovative?
Well, one thing that really stands out is this new feature they have.
Yeah.
It lets small businesses create their own mobile ordering and delivery apps.
Wait, seriously? That's huge.
It is. It levels the playing field with those big delivery apps, the ones that take such a big cut from restaurants.
Right. It gives the smaller places more control, which they need.
Exactly. And Toast isn't stopping there. They're expanding internationally and even looking at moving into other markets, like retail.
Wow, they're going for it.
They are. They're already in almost 127,000 restaurants.
Seriously.
But they think they can reach multiples more. That's what they said.
Multiples, huh? That's a pretty bold statement.
It is. They're definitely seeing a lot of potential out there.
Okay, so lots of growth. But all that doesn't mean much if they're not making money, right?
You're telling me. But good news on that front.
Oh, yeah.
They're becoming profitable. Their net income in Q3 of this year, $56 million.
No way.
Last year, they were still operating at a loss.
So they completely turned things around. That's awesome. Profitability is a really good sign, especially for a company that's still growing so fast.
It definitely shows their business model is working. Now, their price-to-sales ratio right now sits at 4.5.
Okay, and remind me, what does that mean again?
It basically means investors are paying $4.50 for every $1 of revenue Toast generates.
Okay, so kind of similar to Dutch Bros then.
Yeah, I'd say so. Not dirt cheap, but not crazy expensive either.
Right. But risks, though, right?
Of course, always risks. Like with Dutch Bros, competition's a big one.
Makes sense. Other companies doing similar stuff.
Exactly. And Toast needs to stay ahead of the game.
So it's not just them out there.
Nope, not at all. But with Toast, there's another risk, kind of a trickier one.
Oh, what's that?
They're very dependent on what restaurants actually doing well.
Right, because if restaurants struggle.
Toast struggles too.
So economic downturn, people changing their eating habits.
Yep, all of that can impact Toast.
Interesting. Okay, so we've got Dutch Bros, the coffee up-and-comer, and Toast, the restaurant tech provider. Two pretty different companies.
Very different. Both with their own strengths and risks. Makes you wonder.
I know. What do we do with all this information? How do we even begin to compare them?
Well, that's what we're going to do next time. We'll really get into the nitty-gritty, look at their financials, their strategies, and see what we can learn about the competition they're facing.
Sounds good to me. So stay tuned, everyone. This is where it gets interesting. We'll be right back.
Welcome back. All right, so I'm ready to get into those the details on Dutch Bros and Toast.
Me too. We were talking about all that impressive growth last time, especially Dutch Bros opening all those new shops.
Yeah.
But I guess even with all that growth, it's profitability that really matters in the long run, right?
Exactly. Revenue is great, but you got to look at what's left over after all the expenses. That's how you know if a business model is actually sustainable.
Right, for sure. So let's look at Dutch Bros' profitability. They went from $13.4 million to $21.7 million in net income in just a year.
It's a big jump, yeah.
Almost 62%. Pretty impressive.
It is. Especially for a company that's still, focused on expanding so quickly.
Right.
Suggests they're managing costs pretty well, even while opening all those new locations.
So what's driving that profitability, though? Is it just because they're selling more coffee overall? Or are they getting better at, controlling expenses?
Well, the article doesn't really get into all the details of their cost structure.
Okay.
But we can, make some educated guesses.
Like what?
One possibility is they've managed to increase prices a bit without, scaring off customers.
Oh, right.
Or maybe they're streamlining operations at each shop, getting more efficient with things like staffing and inventory.
Okay, so either making more per cup or spending less per cup, or maybe a little of both.
Exactly. It would be interesting to see a more detailed breakdown, though, to really understand where the improvements are coming from.
Yeah, That would be helpful. But for now, at least, that focus on profitable growth, that's a good sign for investors, right?
Absolutely. Very positive sign.
Okay, so let's switch gears over to Toast. They had a net income of $56 million last quarter, a huge turnaround from last year when they were still losing money. And it seems like their business model with those recurring subscription fees from restaurants would be more predictable, wouldn't it, than like Dutch Bros direct sales?
Yeah, generally the SaaS model does give you more stability and visibility into future earnings.
Okay.
Restaurants sign contracts for Toast services, so it's a more consistent revenue stream.
Makes sense. But is that $56 million profit just because more restaurants signed up? Or are they also getting both at managing their own expenses?
Probably a combination of both.
Yeah, probably.
I mean, they added 28% more restaurants to their platform in the last year, which obviously helps.
Right.
But they also have their own costs to manage, right?
Like what?
Well, developing and maintaining the software, marketing, customer support, all of that.
Right, of course.
So the fact that their profit jumped so much, it suggests they're keeping those costs under control, even while they're adding all these new customers.
So that's a good sign.
Definitely. It's a key indicator of a healthy business model, one that can, handle growth without letting expenses go crazy.
Yeah.
Scalable,
Right. Okay, so both companies are showing good profitability, which is great. But we can't ignore the risks, right? We talked about competition last time. Dutch Bros going up against all those other coffee chains.
Yeah.
And Toast facing those other restaurant tech platforms.
Competition is definitely something to consider. I mean, Dutch Bros is going up against, giants like Starbucks.
Right.
And while they've carved out their own little niche, maintaining that growth means they need to, keep winning market share in a very crowded space.
And it's not just about the coffee itself, right? It's about the whole experience, the branding, the convenience, all of that.
Absolutely. Got to stay ahead of the game.
What about Toast? What are the biggest competitive threats for them?
Well, there are a few other companies out there offering, similar restaurant management software.
Right.
Some are more specialized. Maybe they just focus on point-of-sale systems or inventory management, something like that.
Okay.
While others, like Toast, are trying to be that one-stop shop.
So does Toast just need to make sure they're offering the best, most comprehensive platform out there? And the easiest one to use, I guess?
Pretty much, yeah. They have to keep adding valuable features, improving their tech, providing great customer support, just to stay ahead of the pack.
Right. But they also have that other risk we talked about, right? The one that's kind of unique to them.
Oh, you mean the fact that their success is tied to how well restaurants are doing overall?
Yeah, exactly.
Right. Yeah, that's definitely something to think about. Even with the best technology, if restaurants are struggling, Toast's growth is going to be limited.
Right. It makes sense.
Economic downturns,
Yeah.
Changing consumer habits, even things like rising food costs, all of that can impact the restaurant industry. And by extension, it impacts Toast.
So even with the predictability of the SaaS model, there are still those outside factors they can't really control.
Exactly. They need those restaurants to be successful. So they have to be paying attention to those industry trends, anticipating those challenges, all that.
Okay, so we've talked about profitability, competition, and those industry-specific risks. What else should we be considering when we're comparing these two companies?
Well, their growth strategies are actually pretty different, and that's worth taking a closer look at.
Yeah, for sure.
Dutch Bros, they're all about rapid expansion, right? Opening new stores as fast as they can.
Yeah, like a land grab almost.
Exactly. And for now, it seems to be working.
Yeah.
But that strategy has its own, challenges.
Like what?
Well, they need to make sure they can keep up the quality, keep things consistent as they grow.
Okay.
Finding good locations, hiring good people, training them, managing all those supply chains. It all gets more complex when you're growing that fast.
So it's not just about opening new stores, it's about making sure each one is running well, living up to the brand.
Exactly. Otherwise, that rapid growth could, backfire.
Right, it could.
Plus, we got to remember their same-store sales growth is pretty low.
Oh.
Meaning they're not seeing huge increases in sales at those existing locations.
So that's a bit of a red flag.
It could be. It might mean they're reaching a saturation point in some markets. Or maybe they need to do more to keep those customers coming back.
So the growth is impressive, but we need to be watching those same-store sales numbers closely.
Definitely.
Now, what about Toast? They're not opening physical stores, so how are they growing?
Well, they're focused on gaining market share within that restaurant tech space,
Okay.
constantly adding new features to their platform, improving the tech, expanding into new markets.
Like geographically.
Yeah, geographically, and by targeting different types of restaurants.
So they're more about like being the best and attracting everyone.
Exactly. And so far, they seem to be doing a pretty good job at it.
Yeah.
Restaurants are clearly responding to that focus on innovation and customer service.
But they are branching out a little too, right?
Yeah.
We talked about that feature that lets restaurants build their own mobile ordering apps. That seems like a smart move.
Oh, it's a very smart move. Lets them offer even more value to their existing customers and potentially, attract new ones. Plus, it helps them compete with those big third-party delivery apps.
Yeah. Puts them in a stronger position for sure.
Exactly. So they're not just relying on restaurants signing up for that core platform. They're finding other ways to, expand their offerings, become even more essential to their customers.
Yes, smart.
Yeah, it's a good strategy. Lets them diversify the revenue streams a bit and maybe even mitigate some of those risks associated with being so dependent on the overall restaurant industry.
Okay, so we've got these two companies, both with strong growth, good profitability, and distinct but potentially effective growth strategies. What's next? Where do we go from here?
Well, there's one more layer we need to peel back before we even start thinking about picking a winner. Valuation.
Oh, right.
We've got to figure out if those stock prices, if they actually make sense. Are they justified based on their performance, their potential, and all those risks we've been talking about?
Let's do it. I'm hooked. Welcome back, deep divers. So we've seen that both Dutch Bros and Toast are growing like crazy, they're profitable, and they've got, pretty solid strategies. But now, I guess, comes the hard part, figuring out if their stock prices actually make sense.
Yeah, this is where valuation comes in. Got to look beyond all the hype, see if those prices are justified based on, well, everything we've talked about, their performance, their potential, or of course the risks.
Because, a company can have a great story, fantastic coffee even, but that doesn't automatically make it a good investment.
Nope, not at all. So let's go back to those price to sales ratios. Remember those?
Yeah, vaguely. Remind me.
Sure. So Dutch Bros is sitting at 4.1 and Toast is at 4.5.
Okay.
But those numbers by themselves don't really tell us much. We need to compare them to other companies.
Other companies in similar industries.
Right. And also we got to think about their growth, where they're headed.
Okay, makes sense. So for Dutch Bros, we're comparing them to other, restaurant chains.
Exactly, especially the ones that are growing really fast.
Okay, and what's considered a normal price-to-sales ratio in that world?
Well, for those fast-growing restaurant companies, a ratio between 4 and 6 is usually seen as pretty reasonable.
So investors are willing to pay a little extra for that growth potential.
Exactly. But they're not, going completely overboard.
Okay, so Dutch Bros at 4.1, they're right in there.
They are. But remember their same-store sales growth.
Yeah, it's pretty low. Does that change things?
It might.
Yeah.
If the same-store sales don't start going up, it could mean their growth is more about just opening new locations and less about, actually getting more customers in the door.
Oh, okay.
And that could make investors less willing to pay that premium for future growth.
So even though their overall valuation seems okay right now, we got to watch those same-store sales.
It's a big deal, yeah.
All right. Now, what about Toast? How does their 4.5 price-to-sales ratio stack up against other SaaS companies?
Well, for fast-growing SaaS companies, especially the ones expanding into new markets, adding new services, a ratio between 4 and 8 is usually considered pretty fair.
Okay, so Toast at 4.5, they're right in the middle again.
Yeah, pretty much.
Yeah.
But don't forget, their success is really tied to how well restaurants are doing overall.
Right. So does that make their valuation riskier?
It's definitely a factor, yeah.
In what way?
Well, if the restaurant industry hits a rough patch, like if there's an economic downturn or people start changing their eating habits, Toast growth could slow down, and investors might not be as willing to pay a premium for their stock anymore.
So even though the valuation seems okay for now, it's kind of shaky because it depends on an industry that can be a bit unpredictable.
Yeah, that's a good way to put it.
Okay, so we've looked at valuations, compared them to their industries, thought about their growth prospects. Anything else we need to factor in?
Well, one thing to keep in mind is that valuation, it's not like a one-time thing. It's always changing.
Oh, right. It's not static.
Exactly. As these companies grow, their financials change, their strategies change, and the market's perception of their value, it fluctuates.
So even if we decide their valuations are good today, that could change tomorrow.
Exactly. Investing isn't just set it and forget it. You got to stay on top of things, keep doing your research, reevaluating all that.
Makes sense. Okay, so big question time. If you had to pick one of these companies to invest in, which would it be and why?
Oh, man, that's like asking me to choose a favorite child.
Uh-huh. I know, it's tough. But if you had to.
All right, all right. They both have a lot going for them, that's for sure. But for me, I think it comes down to how much risk I'm comfortable with.
Oh, okay, I see. So which one feels less risky to you?
Well, that's the thing, right? While Toast being so tied to just one industry does make me a little nervous, their SaaS model and the fact that their services are kind of essential for restaurants,
Uh-huh.
that gives me more confidence.
Okay.
I mean, restaurants are always going to need to manage their operations, make things run smoothly, and Toast is becoming more and more important for that.
Yeah, for sure.
Plus, their revenue is recurring, so it makes their financial performance a little more predictable, a little less bumpy.
So even if the restaurant industry as a whole has a tough time, you think Toast is still in a good spot to keep growing and making money?
That's my take, yeah. They've shown they can innovate, adapt, and really provide value to their customers. That makes me feel better, at least a little bit.
I get it, but that doesn't mean Dutch Bros is a bad investment, right?
Not at all. They've got a great brand, loyal customers, and they're doing a good job with their expansion. If they can keep those profits up and address those same-store sales concerns, they could definitely be a winner for investors.
But for you, their whole strategy depends on that rapid expansion continuing. And the coffee market, it's pretty competitive, so it feels riskier.
Yeah, that's my thinking. They got to keep opening new stores like crazy A&D, make sure those stores are successful. It's harder to predict than the need for restaurant management software, I'd say.
All right, so your pick is Toast. Slightly less risky, more predictable, in a market that's only going to get bigger.
That's where I'm leaning, yeah. But remember, this is just my take. What's best for you? That depends on your situation, your risk tolerance, your goals.
Couldn't agree more. We've given you the deep dive, the analysis, the whole shebang. Now it's up to you to do your homework and make the call that's right for you.
Yeah. And hey, remember, the most important thing is to stay informed, stay engaged. The investing world, it's always changing. The more you know, the better decisions you'll make.
Well said. That wraps up our deep dive into Dutch Bros and Toast. Thanks for joining us.